Ladies and gentlemen, good day and welcome to Q3 FY23 earnings conference call of Shri, Keshav Cement and Infra Limited, hosted by Kirin Advisors. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Supriya Madaye from Kirin Advisors. Thank you, and over to you.
Thank you. Good morning, everyone. On behalf of Kirin Advisors, we invite you for the Q3 FY23 conference call of Shri, Keshav Cement and Infra. To discuss the performance of Q3, we have from the management, Mr. Venkatesh Katwa, Chairman, Mr. Vilas Katwa, Managing Director, and Mr. Deepak Katwa, an Executive Director and CFO. To give you the opening remarks, now I hand over the floor to Mr. Venkatesh Katwa. Thank you, and over to you, sir.
Yes. Good morning, everyone. Wish you all a very safe, healthy, and a prosperous 2023. I welcome you all to the third quarter financial year 2023 conference call for Shri Keshav Cement and Infra Limited. Shri Keshav Cement and Infra Limited is a Karnataka-based cement company having two business verticals. One is a cement division with the current capacity of around 0.35 million tons with two manufacturing units, and the second division being the solar power of capacity 37 megawatt, which is close to the cement plant. Cement demand is robust on back of increasing spend on housing and infrastructure. Your company is servicing in Tier 3 segment, typically in North Karnataka, South Maharashtra and Goa regions, and is in much advantageous position to be benefited by the rising demand in the region of its presence. The company has three basic advantages. Apart from the locational advantage, the abundant supply of important raw material of limestone, captive power generation whose cost is less than 1/4 or 1/5 of the market price as on date, and we are able to meet the rising demand in the area by saving in terms of freight cost because we are closest to the market. As the demand was robust, it has allowed us to take a price hike of nearly 5% in the reported quarter. So on industry outlook, India has a lot of potential for development in the infrastructure and the construction sector, and cement sector is going to be largely benefiting from this development. Also, on the back of rising rural housing demand, the consumption of cement in India has been growing consistently, and it is one of the cheapest product to buy in terms of rupees per kg of material. Strong expansion of the industrial sector, which has fully recovered from the COVID-19 pandemic shock, is one of the main demand drivers for the cement industry. As a result, there is a strong potential for an increase in long-term demand from cement. Some of the recent initiatives, such as development of 98 smart cities, is going to provide a great fillip to the industry, which it has already begun to show the results. Again, the budget of 2023 announced 33% increase in the capital investment outlay to 10 lakh crore. This goes very well for the demand for building and construction material. The future is definitely optimistic with a strong demand outlook. So, typical business outlook for our company or for the company, management is working on the plan to increase the capacity from current 0.35 million to 1 million ton by adding only the balancing equipment, which are basically focused to reduce the power and fuel consumption. The entire plan is based on a strategy where certain new machinery will be added, certain machinery will be modified to achieve reduction in power and fuel consumption, and also giving increase in production of clinker. We expect substantial improvement in revenues with curtailment in operational expenses, improving the profitability. Currently, our industry being very with the old technology wouldn't be considered as running in a very efficient manner. Most of the larger industries who have done this kind of modification about 10 years back are enjoying the benefits. All that we are doing is investing in the same technology and coming at par with most of the major plants. Now, let me take you through the company's performance. I'm very happy to announce that the revenues have increased by over 20% to 34.81 crore this quarter. Even the EBITDA has gone up to 10.4 crore, which is up by 9.36%. And PAT has been at 1.39 crores, with EPS being at 1.16 rupees. And if I look at the 9-month results corresponding to the 9 months of previous financial year, revenues have gone up to 93 crores almost, with almost 17.2% increase. Revenues from solar generation have almost doubled to around 15 crores from earlier 7.86 crores. This is typically an addition of new 12 megawatt, which was commissioned in the December 2021. So the EBITDA for 9 months has gone up to 28.70 crores, which is up by nearly 9.08%. And PAT has gone up to 29 crores, which is almost 350% higher than the similar corresponding previous financial year, with EPS for 9 months being at around 24 rupees 18 paisa. With this, I conclude my discussion on the company and what I'll be looking at. I'll be very happy to address any questions anyone might have. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Anupama Bhutra from Arihant Capital Markets. Please go ahead.
Yeah, good morning. The first question is regarding fuel, power, and freight cost. If you can quantify for this quarter versus last quarter and similar last year's quarter. This is my first question. And second question is, there's going to be robust demand considering government initiatives and so many other initiatives. So it can be a game changer for small to medium scale companies. So I just wanted to understand what are the company's strategies and plans to capture and tap these upcoming opportunities. So, yeah.
Sure. So first question, I missed on some little details. So did you want the power price of the this quarter compared to the last quarter?
Yeah, fuel cost and freight cost. In fact, lead time, if you can give us some data points.
Sure.
Lead distance, basically. Yeah.
Sure. So the fuel cost typically, which is why you see our cost of raw materials has gone up by nearly about 60 to 70%, is primarily on account of increasing the fuel cost. That is because till now we were using the old coal stock, which was purchased about last year. So this quarter we have completely switched over to petroleum coke, because utilizing coal or buying coal at the current prices would not be feasible, and the company had done some kind of a modification to the plant about 2 quarters back, so that we could use entirely petcoke just like all the other major plants. But the cost of petcoke itself also has gone up, not as high as coal, but it has still gone up. For example, in the last quarter, the coal that we used, the average price of coal was around 8,000 rupees per ton. And in this quarter, we have used petcoke, whose average price is around 16,000 rupees per ton. Even though petroleum coke has very high carbon value compared to the coal, but still there is an absolute increase in the cost of fuel, which is why we tend to see that the cost of raw material has gone up in the figures. So as far as logistics is concerned, in a significant manner, most of the logistics is out of the purview of this balance sheet because the company has been selling significant, almost 80% of the cement by way of ex-plant basis. So even whatever increase or decrease in logistic cost, is available in the market has been successfully passed on to the customers. So I do not have an exact price increase data per se, but since we have been selling most of the product on ex-plant basis, we have shielded ourselves against increase in the freight cost. So did that answer the question?
Yeah. So in terms of logistics cost, like you mean to say 100% is passed on?
Correct. Since we sell most of the cement on ex-plant basis.
Okay.
So typically we ask dealers to take they enjoy the benefits when it goes down. They also, in both directions, if it goes up, they take a hit. And the second question you asked was regarding how are we going to adapt to the changing scenario and expected demand.
Yeah, correct. And maybe, a lot of opportunities coming. So for companies like Keshav and other small to medium companies, it can be a game changer.
Absolutely. So there was a time when big was beautiful, but now what is happening is efficiency is going to be the key. For example, logistics do definitely play an important role for the final price on the retail side. So if a major plant has to supply cement in my market area, they would be spending not less than about 1,800 rupees to 2,000 rupees per metric ton, as opposed to what I'm spending around or what my customers will be paying around 600 to 800 rupees per metric ton. So that delta benefit I tend to get. And with this, company is also planning on modernizing the plant so that not only there is a fuel and a power efficiency, there is an increase in production. So at 1 million ton level, you could bid for larger infrastructure investment projects, which the company is not able to do right now because of certain inefficiencies, because the plant being old, which was a sick plant purchased in 2007. This plant was built in somewhere in 1980s. So now that with the modification, we will be at par with the cost of production with all the major plants. And then the biggest benefit we'll have is we will be able to supply to the bigger markets like Pune, Bangalore, which becomes restricted right now because of lower EBITDA margins compared to other plants. So our restriction comes from local market itself. But in spite of that, we have a very good brand image in the local area. We sell almost at par with tier 2 brands. With the expansion, we look forward to capture better and a bigger market. Thank you.
Okay, thank you so much. That's very helpful.
Sure.
Thank you.
Thank you. We have our next question from the line of Raj from Arjav Partners. Please go ahead. Mr. Raj? We are unable to hear you.
Now it's good?
Yes.
Achha, I'm intending to ask about FY24. So how would your sales figure gonna look like?
No, I couldn't get the word exactly. How does what look like?
Now it's fine? Now you can hear me, sir?
No, it is breaking, sir.
Now it's fine? Hello?
Yeah,
can you hear me now?
Yes.
Achha, I am intending to ask how will your FY24 gonna look like from sales and everything, margins?
Okay. So FY24, since the expansion what we are doing will show up as a full capacity in FY25, FY24 will certainly be better than the correct FY23 only because of two main reasons. The cost of power generation will keep going down as we keep repaying on the interest, and the selling price of power will keep going up. With that and with the utilization of petcoke, company is hoping to better its performance in FY24. But still, we would not have seen an expanded capacity then. But to some extent, there is going to be improvement in efficiency as well as in production.
Also, can we expect the expansion which you are doing? So it will be into the system from FY25 onwards, right?
Correct. So expected completion date is around March and April 2024. Keeping about 1 or 2 months as the teething issues. Yes, FY25 should show the full capacity.
Full capacity list. All right. Thank you. Have a good day. Bye.
Thank you.
Thank you. We have our next question from the line of Hemant, an individual investor. Please go ahead.
Hi, sir. Good morning.
Good morning, Hemant.
Sir, I have few questions related to both cement and solar. So my first question is related to solar. We have invested around 190 CR till now in solar.
Sure.
From FY18 till date.
Correct.
So what is the total ROI which we had till now in solar?
ROI for solar is certainly higher side. I didn't calculate the exact figures, but our EBITDA is coming in the range of, so this year for 9 months, our EBITDA for solar is around 25 crores. And with the last quarter being adding up, around 32 to 35 crores EBITDA is expected from solar. So you could say, a return on investment would be around 3 to 4 years or so. Sorry.
So in 4 years we have touched this 190 CR.
Correct. Or around 5 years, sorry, yeah.
5 years, okay. Sir, in terms of cement, in FY18, our capacity utilization is 88%. And from 88, we came to 37% in FY20. So any particular reason for that?
So FY18, we were operating at a 0.1 million ton capacity. We had reached almost 90% capacity utilization. After the expansion of nearly 3 times, the capacity utilization has come to around 63% last financial year, which is FY22. So this FY23, we will be bettering it. In fact, this quarter capacity utilization was around 73%.
Okay. So only because the capacity increased, we could see the drop in utilization.
Correct.
But there is no drop. So, but there is no
drop in sales figures. There is no drop in the quantity or sales. Only the capacity utilization, because we have to calculate the utilization against the rated capacity.
Okay. Sir, one thing I want to understand regarding the solar, we are doing 30-35 CR EBITDA per year.
Correct.
So how much % we are using internally and how much we are selling outside for the current capacity?
Around 40% we are utilizing inside, 35 to 40% we are utilizing inside, and we are selling nearly 65% outside. But with the expansion of 1 million tons, we'll start consuming 90% inside and 10% will continue to sell outside. We still are over capacity in solar even for 1 million tons.
So what is our target, sir, from FY25 onwards? What will be our target for capacity utilization for the 1 million tons?
Even if I go by 60% utilization for the first year, we are expecting a top line of around 350 to 400 crores with better EBITDA margins, because the whole project is based on the concept of fuel and power efficiency. Sorry, go ahead.
Okay. So if we calculate 60% utilization in the first year, which is FY25, our EBITDA would be 60 crores if we calculate 1,000 rupees per ton. Is that right?
Correct. Yes. That is what we're looking at. Yes.
So here is where I have major query, sir. When do we start increasing our capacity for solar internally, our solar EBITDA comes down. So now it is 35 CR, but in FY25 it will come to 20 or 15 CR.
No.
Is my understanding right?
No, solar EBITDA is based on the value at which given cement is consumed. The captive consumption also is taken as a value for solar. So which is why my cement EBITDA is around 250 to 300 rupees, precisely because I have considered the cost of power at the price what I'm selling outside. So EBITDA for solar will continue to remain as it is. This 1,000 rupees what we are talking about, it is considering the cost of power at around 7 rupees, which is what we are selling. But that is a good
once the EBITDA increases in cement, whatever amount we are getting in solar now, that will get captured in cement EBITDA. So EBITDA will
continue. No. All right. So I will clarify that point. Cement, solar EBITDA of 30 to 35 crores will continue even if we are utilizing 90% power inside. Because cement EBITDA, I'm calculating in assuming the power cost of my sell price.
Okay.
In short, if you're taking it as a captive power generation, instead of if you're taking EBITDA based on only what I'm selling, my cement EBITDA will go from 60 currently about 5 to 6 crores, what I have to nearly about 90 crores. In the direction of the calculation, what you're thinking. I'm separating solar EBITDA, assuming the captive consumption is sold at a price to internally.
Okay. Now I got the answer, sir.
Yes.
Thank you so much.
Sure. So 1,000 rupees EBITDA target, what we have done for cement is because that includes the cost of power. If I don't include the cost of power, my EBITDA part doesn't reach almost 2,000 rupees. But yes, I hope I could clarify that.
Yes, sir. So once this capacity increases, do we have a good number of dealers in larger cities like Bangalore, Mumbai?
Typically, I would. So what happened is my first target is going to be institutional buyers. A lot of bidders, the government buying, which I'm not able to do right now because of limited EBITDA and that I have to cater to my existing dealers. And the institutional buyers are long-term buyers and large quantities which I'm not able to service at the current capacity. So I will continue to hold my local area, almost 80% of my sales. Maybe 20% I will look outside the home market.
Okay. Okay, sir. That's it. I don't have anything else. Thank you so much and all the best for this year.
Sure.
Thank you. A reminder to participants to press star and 1 to ask a question. We have our next question from the line of Vaibhav Shah from Cogent Research. Please go ahead.
Thank you. Congratulations on a good set of numbers. So I have two questions related to expansion. How we are finalizing the fundraise for the expansion, sir?
Sure. So just last week, the entire finalization has been done. The project cost is around 125 crores, and bank has agreed to fund 80 crores. The rest, 45 crores, we are raising equity via preferential issue. So as said, we have begun to negotiate. We have received some soft commitments. So most likely next couple of weeks we should be able to close it.
Okay. So 80 CR will be the debt funding and around 40-45 CR will be from the preferential equity.
Yes.
Okay. So debt is at what level, at what rate we are finalized?
I have to still receive the sanction letter from the bank, but from my internal resources, around 9.1% is the rate of interest what they have indicated on the committee table. So unless I get it on hand, commenting beyond this, is really difficult.
Okay.
So our current debt is outside debt is around 152 crores on the books. Outside debt, you mean only outside term loans, excluding promoters' debt or excluding working capital limits.
So as on FY22, you had outside debt, total debt of around 200 CR. Out of which other 150 CR is from outside and rest is of promoters. Is it correct?
Okay. FY22 around outside liabilities were 172 crores.
Okay.
And the rest coming from promoters' loan and working capital. That 172 has come down to around 154 now.
Okay, got it. So this 150 is at with what cost?
Most of it is because of solar.
Yeah. That I got it. But what is the interest cost for this?
Right now it is 9.55%.
9.55.
That is planned to be reduced to 9.1%.
Okay. So your overall whole chunk will reduce to the 9.1. So once it is, we are assuming the debt is coming in. So what will be the total debt, including with the promoters' contribution, after the expansion?
So after the expansion, what typically is happening is all the promoters' debt in the books, we are converting that also into equity. That is excluding the fresh equity of 45 crores what we are raising. So the equity conversion at the time of preferential issue will be 45 crores from the investors, around 30 crores promoters will be investing by converting the unsecured debt into equity. So typically in books we will expect around 75 crore equity to come and around 80 crore debt to show up by after the closure of preferential issue allotments.
Okay. So overall debt will be around this 150 plus 80, correct?
Yes, 150 plus 80 is 230 is going to be debt, and our equity is from current 50 to 130.
Correct. So what will be the promoter will be holding after the conversion and preferential, if you have done any calculation, approximately?
Sure. Approximately right now we are holding, the promoters holding about 73%. Post-pref, likely that we will hold around 64 to 65%.
Okay. After conversion also?
Correct.
So conversion you are planning will be at the about the same as preferential price, or it will be a bit different?
No, same price. What investor price will convert? Yes.
Oh, okay. So on the expansion front, I'm just too curious. How much time it will get to the plant up and running? I think you have answered in some of previous questions, but I just want a bit more clarity. If you have, what will be the lead time for the equipment and all, and how much time it will take to, let's say, trial run and to stabilize the plant? It will be to be the fully operational.
Sure. So typically, as of now, based on the negotiations and assurances from our suppliers, typically it will take about 14 months from first dig to first bag out. But some part of the work we have already begun with the internal resources. So at the moment the funding is flowing in, the full work will start by end of March. So we are talking about 12 months. The target is to complete by March 2024. You could take a grace of another couple of months just in case.
Okay. So I think you've been in your presentation also 5-6 equipment that we will be needing. So from the internal accruals, what you have started? On which equipment you have started working?
Some of the efficiency equipment like what is known as we have a cement mill. So we are changing the dynamic separator by which the fineness of cement will increase. We could add more additives by way of slag, thereby reducing the cost of production by around 4 to 5%. So that is something which we will, I think most likely by March 2000 or April 2023, we should be able to commission that. It's a small project, less than around 5 crore costing, but that should get completed in the next 2 or 3 months.
Okay. So now, sorry, I'm just taking a bit more time. A few questions related to Q3 numbers. So what was your average EBITDA per ton for the Q3?
Q3 average cement EBITDA was around 245 rupees.
245.
Yes, that is, and industry is around 1,000 rupees, 1,200 rupees. That is, like I said, mainly because our power, we have a power and fuel inefficiency. I'm having all positive numbers only because of solar, which will continue to stay with me. But now the management wants to fix the cement EBITDA problem, which can be done by modernizing the equipment.
Okay. So, in this, I can see a bit of a dip in the PAT margins. So, EBITDA has grown, but the PAT has declined. So, what was the reason behind that?
PAT typically again due to change in change in fuel cost. See, fuel cost has been very erratic.
I'm not saying your EBITDA has increased on quarterly basis and 9-month basis, but PAT has slightly declined. Not in much, but slightly declined. So, any particular reason? So, your Q3 PAT has gone from around 1.6 CR to 1.4 CR in against previous year.
Yes, I can see that mainly because of. Can you check that? It could be mainly because of EBITDA has increased. No, that is because of increase in finance costs.
Yeah. So yeah, any debt increased or what was that? Because I think your debt has reduced during the year. So why the finance cost increase was there? Just I wanted to understand that.
Okay. So since we have already started with some internal accruals work on some of the equipment, we have utilized the overdraft limits at a higher level compared to the earlier quarter. So if you look at the utilization of our overdraft limit, it was less than 50% in Q2, but in Q3 it has reached 80% utilization because funds, since we are utilizing from internal accruals, those are the funds which were parked in overdraft limits had to be used. So that impact will show up in the interest cost.
Okay. So I think going forward, when our debt is increasing, so how much impact, but how much we can sustain easily? I just wanted to understand what amount of debt servicing we can do easily.
Currently, we are positive on very high on positive DSCR. So you are talking about post expansion or now?
Yes. Post expansion.
Post expansion will be much. The repayment capacity will increase by nearly 3 times higher. Like I said, our current EBITDA per ton is around 250 rupees, and we are targeting 400 rupees.
Yeah.
So with that, in fact, banks for 10 years repayment schedule. Looking at our DSCR, banks wanted to give us only 5 years. They said you have a very high DSCR, very high profitability. Somehow we finalized on negotiating it. We concluded for 8 years now, which they have agreed to.
That's it. So it will be the same banker. I think Canara is your primary banker, correct?
The only banker, yes, the sole banker.
Yeah.
They are not letting Canara to go anywhere else in any case.
That's great, sir. That's very encouraging.
History of not a single day default, not a single rupee delayed since inception till date, and our bankers know about it.
Great, sir. Great. So, any chance of changing the structure of fundraise, like reducing debt, and if you are getting a good commitments from the investors, so any chance of changing the structure, or you have finalized for the 80, 40, 45?
Yes. So this is what even our banks asked us. With even with 8 years repayment, our DSR was crossing around 3.5 times. So they did take an undertaking from us that in case we have surplus cash flows, that we utilize towards closing the loans. Yes, the management will look at doing that the moment we have surplus funds, which is very high possibility from FY25 onwards. And that would be, unless we want to go for another expansion or additional capacity, that would be the direction we want to go.
Okay, sir. Yeah, thank you so much, and all the best for your expansions and further years. Thank you.
Thank you. We have a next question from the line of Himani from Suraj Research. Please go ahead.
Hello.
Hello.
Yeah, am I audible?
Yes, Himani, I can hear you.
Yeah. Good morning, sir. My questions are, today we are selling solar power After expansion, would it be possible for company to sell solar power? How would it impact our margin?
Yes. So typically, even now, the EBITDA calculation that I am speaking up or showing on the document is including the consumption that we are doing. For example, when I mentioned cement EBITDA of 250 rupees, that is considering the cost of power, even though it is free of cost for us in-house. But I have considered the cost of power at the price that we are selling outside. So with the expansion, of course, our sale of power will go down from current about 60 to 65% to less than 10%. But then the benefit of that we would be gaining in cement. So cement, solar EBITDA will continue to show as it is, even when we consume it internally. That is because part of it we are selling it outside. So if you look at present EBITDA, what we are generating, it is higher than about 1,400 rupees per metric ton. That is solely because the cost of power is less than 2 rupees right now. So yes, after post expansion, we will be consuming 90% of the power in house, and EBITDA for solar will continue to show.
Okay. And my other question is, solar revenues is almost doubled in 9 months. Can you please explain in terms of capacity and future outlook as far as revenue contribution is concerned?
Did you say ready mix concrete?
Yes.
Okay, the solar has doubled only because the new capacity was added in the last financial year. I think in Q2 or Q3 we added 12 megawatt, which was almost 50% addition, which is why we see that increase in sale in solar. So regarding ready mix concrete, it is a great new opportunity for our cement plant. Not only does it give a very high top line, the surprise for if we were to use the entire cement into making RMC, which is a possibility, our top line increases by nearly 4 times because of the because each about 6 to 7 bags can produce 1 cubic meter of ready mix concrete. Company is looking into that direction, but right now the focus is only on expansion. And once the expansion starts taking shape, that is something the management will definitely look into.
Okay. And my last question is, as consolidation of cement capacity is happening in industry, would you like to sell cement division if attractive pricing is offered?
You'd be surprised, but they say everything has got a price. If there is a very good price, yes, management will definitely consider it if it adds to the wealth of the shareholders. But at this point in time, management is completely focused in not only increase this capacity. We have existing land with us, where we can add another 2 million ton capacity. And another good news has been there is a railway line which is passing adjacent to my boundary, which will be laid down in the next couple of years. So that could be used as a freight for a cement plant. So when everything all that comes up, we're expecting the valuation of a plant to go high. Of course, at that time, maybe we could look at any possibilities.
Okay. Thank you, sir. Thank you so much. All the very best.
Thank you.
Thank you. We have a next question from the line of Siddharth Aluwalia, an individual investor. Please go ahead. Mr. Siddharth Aluwalia.
Yeah. Hello. Good afternoon. Few questions to ask. So my first question is, what is the quantum of price hike taken?
Quantum of what?
Price hike taken.
Quantum of price, there around 4.6% is what we have noticed compared to Q2 and Q3. So around 170 rupees per ton is what is showing on our books compared to Q2.
Okay. And so what is the capital expenditure for plant capacity expansion through equipment balancing and modernization?
Sure. The capex cost is estimated around 125 crores to increase the capacity from 0.35 million tons to 1 million ton. That is around $25 per ton compared to industry standard of $150 per ton if we had to set up a greenfield project. One of the reasons why we have so low capex cost is because some of the equipment we had modified in 2018 expansion, keeping in mind this 1 million ton future expansion. The land is not bought new. We have sufficient power from our captive unit, and the entire support structure, the laboratories, the stores, everything is intact. We are only modernizing the kiln and increasing the grinding capacity, because of which the capital cost is low. So the project cost is around 125 crores, with 80 crores being raised from the bank and the rest only 45 crores from as an equity from preferential issue.
So you mentioned additional land. So is it in company name?
No, we are not buying. There is no requirement of an additional land asset. We will be doing within the existing factory premises only.
Okay, sir. And how it will be funded?
So funded about out of 125 crores project cost, 80 crores will be funded by the bank, and remaining 45 crores by equity by raising through preferential allotment.
Okay, sir. And what is our EBITDA per ton? Is it still low in comparison to industry norms?
We are extremely low. Our EBITDA per ton is around 245 rupees this quarter, or around say about 2.50 rupees this 9 months, compared to industry average of around 1,000 to 1,200 rupees. That is mainly because, like I mentioned at the beginning, the plant is very, very old, which is why we are trying to correct now. So for my fuel consumption is almost 30 to 40% higher than the industry standards. My power consumption is almost 80% higher than the industry standards. That is because I'm driving an very old ambassador with a very, very bad average, which is what we are trying to fix in this modernization now.
Okay, sir. And sir, how much our capacity is now being used?
So it is reached to 73% this quarter.
Okay, sir. Thank you.
Sure. Thank you, Siddharth.
Thank you. We have our next question from the line of Sandeep Mane from SM Research. Please go ahead.
Hi. Good morning, sir.
Good morning, Sandeep.
Sir, I have one question. So my first question is, can you, sir, please share the production and sales volume of cements for Q3 FY23 and 9 months FY23?
Sure. So for Q3, we were able to produce and sell around 65,400 tons compared to Q3 of previous year, which was around 51,550. So for 9 months ended, it is 1,72,000 tons in Q3 FY23 for 9 months compared to the previous 9 months of the previous year, around 158,000 tons. So there is an increase of around 10%.
Yes. Sir, our EBITDA margin in Q3 FY22 was 32.93, and in this quarter it is 29.88. Sir, can you explain the reason for fall in EBITDA margin and what you expect for FY23?
Typically, EBITDA margin has reduced mainly because of the change in the fuel cost. So even though we, in Q3 FY22, company was using coal as the main fuel. In Q3, it is changed to petroleum coke. Even though, so in Q3 FY22, we could only use coal. Petroleum coke price is always about 20-30% less on per kilocalorie basis compared to coal. So petroleum coke is always lesser. But we could not use it in the last year. We did some modification and we started using this from Q2 onwards, Q2 of FY23 onwards. So once we consume the old coal, now when we are shifted to petroleum coke, even though based on today's prices, even though petcoke prices are lesser, on absolute cost it has increased compared to the quarter 3 of the previous year, which is what has impacted our EBITDA margins. It would have significantly impacted, but had there not been solar. Some of it is recorded because of additional capacity of solar.
Yes. Sir, what is the average production cost for Q3 and 9 months?
What is what?
What is the average production cost for Q3 and 9 months?
Q3 and 9 months, right?
Yeah.
So I couldn't calculate it on this basis, but hold on, I can just give a quick figure.
Yeah, approximately.
Should not be a problem. Yeah. So it in balance sheet it would show up. I would say it could have production costs could have increased a little bit compared to Q2. Only if you look at cement, again because of the same reason what I mentioned.
Sir, what about the debt reduction? Any process on that?
Debt reduction?
Yeah.
So at this point in time, the company is looking to expand and this thing. So we will be taking more debt this financial year. But yes, after the expansion is complete, we would expect that will be the first choice to go if we have to look at surplus funds. Unless we want to invest in some productive assets of more solar capacity or more cement capacity, company will utilize the solar, surplus funds towards debt reduction from FY25 onwards.
Okay.
And most of the debt that we see on the books is because of solar, which is very typical and characteristic of a solar industry. If I separate this debt, less than 25% of the debt what shows on the books is for cement.
Okay. Sir, so why don't you separate both solar and cement?
No, if we have to separate on the company basis, then we will have to set up an SPV. As of now, there are two different divisions. They're all both in the same company, so we have to be showing the consolidated results. In segment-wise debt, will show up the segment-wise distinction on the debt side.
Okay. Thank you, sir.
Sure. Thank you.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone. As there are no further questions, I now hand over the call to Supriya from Kirin Advisors for closing comments. Over to you.
I thank you all the participants and the management team for organizing this concourse. Thank you everyone. For any further queries, you may reach us at research@kirinadvisors.com. Thank you so much and good day.
Thank you all. Bye-bye.
Thank you. On behalf of Kirin Advisors, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
The conference is no longer being recorded.